The Fed's hidden rescue move. Quiet in the bond market or a deep quiet storm? Welcome to the Heart of Economy channel. Today we're talking about a critical development happening behind the scenes in the financial world, a move that may seem technical but actually touches the most fragile areas of the American economy. The Fed is preparing to once again ease to SLR regulation. So, what does that mean? Is this a new privilege being handed to the banks? Or is this a covert rescue operation hinting at an upcoming collapse? Let's break down this unseen yet powerful move in all its dimensions. What is the Fed doing? The technical adjustment currently on the Federal Reserve's agenda holds major importance for how large commercial banks manage their balance sheets. The Supplementary Leverage Ratio is a regulation developed after the 2008 financial crisis. It requires banks to hold a certain level of capital against all their assets, whether risky or risk-free. This means the rule applies even to U.S. Treasury bonds which are considered risk-free. Originally designed to reduce systematic fragility after the crisis, this regulation has now begun to clog the liquidity arteries of the system. In 2020, at the height of the pandemic crisis, the Fed temporarily exempted banks from the SLR requirement. The result? Banks were free to buy treasuries. The Fed supported government borrowing. The financial system was saved from collapse. Today, the Fed seems to be taking the same path again, but this time there is no visible crisis. So, the real question is, what is the Fed seeing ahead of time that makes it take this step now? What is the SLR? Why is it so critical? The SLR requires banks to hold a minimum of 3% capital against their total assets. It doesn't distinguish between risky loans and risk-free treasuries. This makes holding large volumes of treasuries less attractive in terms of profitability. Capital costs rise, leverage ratios drop. Right now, the US Treasury is borrowing at record levels, but finding buyers for that debt is becoming increasingly difficult. Traditional buyers like China and Japan are reducing their holdings. Domestic demand must rise. If the SLR is loosened, big US banks could re-enter the Treasury market strongly, helping to keep government borrowing costs under control. So this regulation, though technical, has direct macroeconomic implication. Some even call it a form of stealth QE, quantitative easing. Who said what? Comments from key figures show that the Fed is under pressure on this issue. Christopher Waller, Fed Governor, if market functioning deteriorates, we might need to revisit tools like the SLR. Sounds technical, but it's a clear message. The system is under stress. Lael Brainard, former Fed Vice Chair, relaxing capital rules may look like a favor to banks, but it can be necessary to ensure financial stability. Jamie Dimon, JP Morgan CEO, markets are very comfortable. If the Fed relaxes the SLR, it's a clear liquidity injection, and markets love liquidity. Austan Goolsbee, Chicago Fed President, with new tariffs and uncertain inflation outlook, loosening regulations may send mixed signals. These statements reveal a true division within the Fed. One side argues that technical easing is a preemptive safeguard. The other questions the timing of such a move. How did the market react? The market interpreted the Fed's move as a backdoor stimulus. Bond yields fell slightly. Expectation rose that banks would return as major buyers. Bank stocks rose, especially JP Morgan and Goldman Sachs. The dollar weakened, liquidity expectations shifted demand toward risk assets. This move showed that the Fed can create expansionary impact without cutting rates. In fact, it may be one of the most strategic communication maneuvers of Jerome Powell's tenure. What's the Fed's real intent? There may be several strategic reasons behind this technical adjustment. Bypassing political pressure. Rate cuts draw political attention, especially in a post-election atmosphere, potentially threatening the Fed neutrally. SLR easing is more discreet. Saving the bond market. The Treasury's debt load is growing. With foreign demand shrinking, domestic buyers must be empowered. Preparing against recession. Even if not officially declared, signs of slowdown are visible, from home sales to retail data. The Fed may be trying to offer support without cutting rates. Targeted relief without overheating. SLR easing doesn't affect the whole system like a rate cut would. It gives breathing room especially to big banks, avoiding over-stimulus concerns. For all these reasons, the Fed may have found a way to stimulate the market without pulling the rate lever. Calling it a hidden bailout isn't too far-fetched. What could happen next? Based on these developments, here are 3 possible scenarios. Scenario 1. Balancing act. Fed slightly relaxes the SLR, banks resume Treasury purchases, rates stabilize, credit flows, inflation stays in check. This is the Fed ideal outcome, a soft landing. Scenario 2. Overreaction. Markets interpret it as a stealth stimulus. Risk appetite surges. Stocks inflate. Bubble risk grow. Inflation expectations rise. The Fed may later have to pay the price with higher rates. Scenario 3. Confidence crisis. A contradiction appears between the message of "we're not cutting rates" and the action of loosening rules. Investors, especially foreign, may question the Fed's strategic coherence. The dollar becomes vulnerable. As you can see, this isn't just a technical tweak. It's a strategic move deep inside the veins of American monetary policy. The Fed is supporting the markets without cutting rates. Is this a chess move or an attempt to cover up cracks in the system? What do you think? Is this move financial brilliance or a delayed reaction? Be sure to share your thoughts in the comments. Don't forget to subscribe, like the video, and turn on notifications so you don't miss future deep dive analysis. See you in the next video on the Heart of Economy channel. Stay tuned.